anytime soon, as there are no medical solutions to the pandemic just yet. BSP Governor Ben Diokno has earlier said the economy may face a deeper contraction if a second or a third wave of COVID-19 infections emerge. He's pointing out to a W-shaped recovery where the economy would bounce back and then sharply drop before fully recovering. Okay, so amid all of the bleak news, I'm kicking off the markets this Tuesday with some good news with Moderna, which is, of course, a healthcare company doing vaccine tests showing that the immune system response is existent in human beings. And you can see on my terminal here how Moderna has risen by 20% in just one day of trading. And take a look at just the right side here. It's 309% up since the outbreak. So again, this is very, very big news. The vaccine test showing an immune system response in human beings. That has also led to jumps in companies like Apple, AstraZeneca, other healthcare companies like GSK, but also the battered companies like Ryanair Holdings and other airline firms, where analysts were saying they might be benefiting, of course, if this vaccine does come into play. Now, let's take a step back, however, and just take a look at the COVID-19 cases. We haven't had this in a while. It's now actually topped 4.8 million cases worldwide, with deaths standing at around 318,000 deaths. However, you can actually see 1.8 million recoveries. There's still, of course, a lot of bad news here. You've got the US deaths from COVID surpassing 90,000 and confirmed cases topping 1.5 million. Now, I just want to go back here and show you the map, because this is a very interesting chart that Bloomberg has for us, the map virus. You can see here on my maps how the cases, okay, so the brighter the color, so the more white the color, you've actually got more cases there in total, and the darker the color, the lesser amount of cases here. But what I want to show your attention to is the fact that if you take a look at the changes in cases, so for instance, the 1 day percentage change, it's actually much less than we've seen in the total cases. Another thing to be watching out here is the equity markets. You can see globally across the world, they have been in the green, at least for the first period overnight trading in US as well as here all over in Asia. So again, just taking a quick peek at those equity markets as they spill over into here in Asia. Take a look at the Dow Jones surging by 3.8%, S&P 500 as well as the Nasdaq. Now over in the EU as well, rebounds all over the place ahead of the trading in the US, and you can see Asia Pacific enjoying those stellar gains, still on that vaccine possibility of hope at the end of the tunnel, with the Topix up by 1.6% as of 10:15, the Nikkei 225 as well, and even in Hong Kong as well as China, you're seeing strong gains here. Now again, apart from this, you've got also good news here in Europe. I did mention that there was a lot of rallies over in Europe. Italy having the fewest new cases since early March. They're starting to open flights from June 3rd. They're starting to open things like salons. Over in the US, the New York State is urging sports to resume without fans. Texas is opening things, even like daycares and bars this week. And another thing is the US benchmark actually jumped the most in almost 6 weeks. Today, this is Tuesday, Fed Chair Jerome Powell is scheduled to speak on the state of recovery amid expectations that he will be pressing for further fiscal response. He also says that the rates will stay near zero until the US is back on track. We've also got Treasury Secretary Steven Mnuchin saying that he expects the economy to improve in the third and fourth quarters. Recall that in the US, you got unemployment surging to 15%. That's the highest since the Great Depression. 36 million Americans have lost their jobs so far. Now, you've also got over in China, President Xi Jinping saying that China will make any coronavirus vaccine universally available once it's been developed. Now, another thing Of course, I do want to check in on our local markets and how we are doing. Indeed, enjoying that rally. Take a look at my terminal here, up by 1.4% this morning. We're back to 5,500 levels. That's after having been sold off to 5,400 levels yesterday. We also had very slim volumes yesterday, just around 4 billion pesos in value turnover. Net foreign selling continuing, but that was actually trimmed to 343 million pesos. Now, some earnings that the markets will be digesting today. Let's kick off with East West Bank. You can see on your screens here the earnings for the first quarter, revenues up by 45%. That's on the back of net income actually up by 75% to 2.3 billion pesos in the first quarter, and on the back of them having reduced their cost to income ratio to just 48% versus the previous of 60%. Loans, however, up by 6%, so not necessarily double digits there, but total assets as well up by 3%. Now, what they did mention is that they were able to make their net interest income jump by 42%. That's around 70% of their revenues. But even their trading gains jumped by 52%. They've also, however, allotted, just like all the other banks, more than 2 times higher for the loan provisions in the first quarter. They allotted 2.4 billion pesos for the loans that might turn sour in the first quarter. And their CEO, this is Antonio Moncupa Jr., is saying that they were looking forward to another record year, but now they have to be ready that the profits could actually be lower. Now, East West Bank, you can see on my terminals here, however, enjoying as well a rally of 4.4% at this open. So a pretty good showing for East West Bank. And I just want to close this first market hit with ABS-CBN, because that is, of course, one to be watching out. It's actually ongoing right now. They have a discussion right now ongoing, and that has been a very volatile stock. Recall that it was 8 days suspended after it had lost its congressional franchise and went off the air. When it had opened, it slumped by more than 14%, paring back those losses. But it seems that the day after it reopened trading, it's still continuing the bleeding. That's down by 2.7%. There's still a lot of uncertainty here, with the House of Representatives reconsidering the second reading approval, which had sought to grant this provisional franchise until October 31. So again, there was this hopes on the second reading, which was passed, but right now the House of Representatives reconsidering that. So more on markets later on in the broadcast with Royce Aguilar of First Metro. Okay, let's check in on other headlines we are watching this Tuesday morning. Big ticket projects under the Build program will be spared from budget cuts. That's according to the DPWH. Now, this comes amid the reports of deeper budget cuts haunting some departments as the government looks for more funds to utilize in the fight against COVID-19. The Public Works Department says that among the unaffected big-ticket projects are the Metro Manila Skyway Stage 3 and the Tarlac-Pangasinan-La Union Expressway, or the T-Plex extension. Now, last week, the department said it also resumed work on several bridge projects that's in Metro Manila. The Transportation Department, meanwhile, said smaller infrastructure projects will not be canceled and will still proceed, since only a portion of their budget had been realigned for the COVID-19 response. The DOTR did not provide the list for such, but said it involved 35 transport projects worth around 15 billion pesos. You can see on your screens here, both the DPWH and the DOTR received budget cuts to augment the funds for virus containment efforts. The Public Works Department received the biggest budget slash by more than 100 billion pesos. Amid a modified lockdown, construction works continue for the DPWH, which will be releasing a final list of projects that have been affected by this budget cut. The Energy Regulatory Commission says it has been bombarded with complaints from customers over their high electric bills And this is why the ERC is now ordering Meralco to explain its calculations for the customers' billings in the past 3 months. In a letter, the ERC required Meralco to submit data or information to validate its monthly billing calculations since the ECQ started. Meralco said some March and all April bills were estimated based on the average daily consumption of the customers from the past 3 months, in line with the distribution services and open access rules issued by the ERC. The power distributor said several factors may have caused the apparent spike in electricity rates, including an uptick in power consumption during the quarantine and high temperatures in May, which led to more use of cooling appliances. Meralco rates for this month are set to go down due to a reduction in its overall electricity rates by 25 centavos. Now, the grace period for residential and commercial rents still applies to areas where a more relaxed version of the community quarantine is enforced. This is according to Trade Secretary Mon Lopez. Recall that a 30-day deferral for the rents was first applied through a DTI memorandum back in April. Now, cumulative rent due within the quarantine may be amortized over a 6-month period. That's after the lifting of the lockdown. Now, while that is good news for some residents and small business owners, people returning to the workforce in areas under the GCQ and ECQ admit that they remain fearful of contracting COVID-19. A survey by health maintenance organization PhilCare shows that 77% of respondents worry about their safety when they're leaving home for on-site work. The study surveyed in 400 respondents on May 10 to 14th via telephone. So markets are seeing the light at the end of the tunnel with some hopes for a vaccine, but still the economic impact is still a lot of guesswork at this stage. Never thought we would say this, but perhaps now is the time to be thinking short term. We have with us Royce Aguilar of First Metro Securities to talk about the here and now of trading. Royce, and welcome to the broadcast.
Hello, good morning.
Okay, Royce, let's talk about globally here. I mean, it's very exciting news. We've joined in the rally of Wall Street overnight and the rest of Asia. We were talking about this off cam. Airlines in the U.S. surge. And we're actually seeing macro Asia also surging right now. Does this show that there will be some sort of V-shaped recovery in these depressed stocks? And are people also pricing in the vaccine?
Well, I think it's a big difference compared to seeing a V-shaped recovery for airlines, tourism, compared to the likes of malls and the like. Kasi the thing here, for airlines, we may see a change in trend in terms of tourism moving forward. So in terms of this rally, in terms of airline maintenance related, it may be not sustainable for the moment. We want to see the consumer behavior once the ECQ is lifted, once the airline operations are resumed. So there.
Okay, so we don't know yet whether this rally is sustainable. Let's just talk about the US first of all, and that rally. It's been on a euphoric run even before this whole pandemic hit. It went through the trade wars, relatively unscathed. It still did pretty well. How resilient is the US economy, especially now that they're coming out with these unemployment statistics? But nobody seems to be that worried about the fiscal space. There's a lot of money still in the coffers. So do you feel that the contagion in terms of the economic contagion of the pandemic will actually be contained? And if this country, which is the leading economy in the world, gets contained, does that spill over into the rest of global markets?
Well, first for the US, in my opinion, I think the US is relatively expensive already compared to the other markets. Of course, US is more resilient compared to the others as well. But the thing here is, of course, based from what I've read, in terms of the PE ratio, it's poised to be higher because earnings guidance have not been all of the corporate earnings guidance have not been gotten yet. So should they get more guidance, the earnings part of the PE ratio will set to be lower. So the PE will be higher. So it's set to be more expensive, and this is the second most expensive valuation of the US markets, with the tech bubble being the last one. So we should keep that in mind given the bad data moving forward. Of course, the bad data may be priced in already, but keep in mind that there's still a lot of uncertainty out there. Vaccine is the solution. So we're seeing that in terms of news flow and
Let's move to domestic, Royce, because we are, of course, enjoying an uptick here right now, 1.5% up. And you can see on my terminal here how we've been moving sideways. So we're still up since that May, 19 low, March 19 low. We've actually still been trading sideways. We're crossing over on the short term moving average here of 50 days. And tell us what are the indicators saying. We haven't pa naman been overly sold off, So is there still some downside risks here? What is the RSI telling you? What's the momentum happening right now? Okay, I'm trying to get Royce back on the line. I can't really hear him properly. It might be the weather disturbance also just yet. But just to pick up later on where we were at, as I mentioned, the index actually enjoying those gains. Let's take a quick peek at my terminal here on which ones are actually the big movers of the day here. You're going to be seeing BDO up by 3.8%, together with just very quickly here you can actually see several of the mall operators. For instance, Mega World up by 3.7%, Ayala Land also up by 3.4%, and Ayala Corporation up by 3.2%. Now we do have several strands on these mall operators. You actually have Ayala opening the malls as of yesterday. So there was 18 malls that were reopened in May of yesterday. But nevertheless, SM Prime actually, which had also opened their malls, is as well as RLC, and I don't see that in the movers list, but SM Prime is actually down by 0.3%. Okay, so I think Royce is back on the line. Royce, can we bring you back here? There you go. Okay, so we were discussing about the indicators here that we were showing to our audience, especially the RSI. It doesn't seem to be necessarily oversold yet. Are there a lot of downside risks still on the table, especially since we seem to be consolidating already towards the 50-day moving average? Okay, we really don't hear his audio. Royce, we're going to try and get him back while he fixes that. But as we were mentioning earlier on the malls and the outlook on those malls, I'm going to try and pull that out for you because I'm very interested to see how the mall operators are actually doing during this reopening of the stocks. Let's take a look at that. I actually have that on my charts here, the malls chart. I just want to show our viewers here. Okay, so these are the biggest mall operators: SM Prime, Robinson's Land, Ayala Land, Vista Land, and Mega World. Now, this is the start of the year. Okay, so the year to date start. And you can actually see the white line and the orange lines are SM Prime and Ayala Land, and they have performed relatively better compared to its other counterparts, Mega World, RLC, and Vista Land. So just a strong showing here. These stocks, of course, all have been heavily sold off, as you can see, since the year-to-date beginning, but nevertheless picking up steam compared to the other smaller mall operators. This, of course, comes after SM Prime announced a first quarter net income which was down by 5.7%, but they did mention that they are still keeping their capex options open, and also that they are not actually slowing down their expansion plans. Now, another one that I wanted to watch out for here, this is actually Royce's stock pick, is RRHI and how that is doing, because Robinsons Retail owns, several things. They own the supermarket of all the Robinsons chains, but they also own other things in terms of retail, for instance, Stop Shop, or the True Value and things like that. So other retailers here. They've also got the consolidation of the stance part of their business. They did mention they will be scaling down this year to between 60 to 100 stores. Their initial plan was to actually have 100 to 150 outlets here. Royce, are you back on the stream? I can see you backstage here. There you go. Okay. So I was actually talking about RHI, which incidentally is your stock pick right now. Tell us, the same store sales growth target has been cut now to 0 to 3% from 3 to 5%. I mean, is this good enough for you to say that this will be recovering, especially since they already had the issue of consolidating Rustan's ahead of the pandemic, and they were largely hit by this. So tell us why you're bullish on this stock.
Well, for RHI, actually, we are bullish on how they turned around Rustan's quickly, and now it's actually helping the bottom line of the company. Also, we do think that it's already priced in the lower SSG target. It's already priced in. What we like about RHI is it benefited from when it was ECQ, because 70% of its operations are operating. And as of the moment, you see hardware stores, toy stores already operating as well. So it will further help RHI's earnings moving forward, relatively stronger compared to the other index names, which may be affected by lower Western price, lower prices of um their selling prices and the like. So there's a huge difference there. That's why we like RHI. We see them as a consumer staple, which is a need, especially that's the trend right now. Consumer needs. That's the trend. And RHI will ride up on that moving forward.
Okay, they've also mentioned that they're escalating their e-commerce push. So they're actually cutting down on the outlets. So instead of 100 to 150 outlets, 60 to 100 stores na lang. Is it a good pivot? Because you see that the capex plans of SM Prime, for instance, have not necessarily changed. So they're still banking on the malls, on the physical malls opening, people coming there physically. And RRHI seems to be banking on the new normal going to do e-commerce. Is this something that markets are appreciating?
Well, as of the moment, not yet. We do think that e-commerce is relatively small in terms of the earnings contribution in companies. So they're not looking at that much yet. I think, for example, SMPH, there may be a trend of lower malls contribution moving forward, but we see pent-up demand there. So there, and for SMPH specifically, you're going to price in the reclamation project. So that's something investors are looking at again moving forward.
Okay, let's talk about the malls because I had pulled this out when we were off stream. Tell us what your outlook is on this mall. So this is a normalized chart, and you can actually see Ayala Land, SM Prime, leading the rebound compared to the other smaller operators. Are you seeing a shape recovery for the mall operators once now the lockdown has been partially lifted elsewhere? How is the behavior? What is the behavior like already?
Okay, for mall operators, we do see a recovery from there, but it's yet to be seen whether it will go back to the normal levels of earnings back 2018, back early 2019. There will be a recovery, but I think it's more on we have to be patient in regards to whether it will go back to pre-COVID levels, because there may be a change in trend, there may be a push online, slowly, gradually, but as of the moment, definitely there will be a recovery. But in terms of the weight of the recovery, it's yet to be seen.
Okay, let's move to consumer stocks because you were mentioning that the non-discretionary items are what's important right now. URC earnings though seem to have disappointed the market. Why is that? In the first quarter, and then they're trimming for their capex and trying to conserve cash. They did mention that it was a lot of foreign exchange losses. But tell us what's going on here because a lot were expecting that the cup noodles, the whatever, the chips would be the saving grace of URC, and if you see pure gold, the shelves have been off the charts in terms of supply. So why isn't the producer benefiting from that?
That's a good point. Okay, so for URC, the difference is the underperformance in its international operations. The domestic was
Okay.
actually strong. What was weak was the international, specifically in Indochina, mainly because there's a different policy there in terms of preventing consumption outside of the house, where compared here domestically, um, few people can buy, and actually some of the reliefs food that have been given to communities are URC products. You will see the same trend in terms of international only in Australia, in Oceania, and that's where you'll see a bit of a support in the international operations. But overall, URC's earnings were kind of lower because of its international operations, specifically in Vietnam, Indonesia, Thailand. So there. But moving forward, we do see URC strong still domestically, and once the dust settles, we see the international recovery. But bottom line, the domestic will continue to drive earnings. So there.
Okay, but can you, I mean, compared to Century Tuna, for example, which saw a major surge, why don't we see that in even the domestic side of the business? And also, are these surges just because of the lockdown period? Is this something that's, more fundamental? And, they've been trying to improve their coffee business as well and streamlining a lot of their costs. It was a turnaround play from last year, for instance. So is this something not necessarily and just fundamental to the operations of the company?
Well, I think well, when we compare CNPF to URC, I think the big difference is for CNPF is most of its products are actually a need. The difference for URC, for example, we have the chocolates, some junk foods are not that part of the essential goods. So you will see a bit of a
Okay.
difference there. But moving forward, you're right. You mentioned the lower cost, the streamline of cost. That will also drive them moving forward. You'll see a bit of a lower earnings, especially in the second quarters, specifically still in the international operations. We still see URC as a relatively safe haven bet compared to other index names as of the moment, given that most of its products are actually part of the essential goods.
Can you
Yes.
actually give a target price right now, Royce? Or is this a time giving target prices?
Well, as of the moment, we're still competing. We're still competing for URC, but bottom line with our clients, it's a buy for us. Our previous target price was around 166, so we have
Okay.
to further evaluate that.
Okay, so still understanding what's going to go and happen in this pandemic. I just want to close with FGen because we need to break the earnings for first gen. This is another essential business power and how that's being affecting everybody here. First gen's first quarter net income down 20% year on year, $5 million, with electricity sales down 10% across all platforms. And you've also got Meralco having already mentioned their earnings still in the green for the first quarter, but saying that the second half will be looking bleak. But doesn't the residential arm, everybody working from home, summer with air conditioning, offset the need for offset the losses that they feel in terms of businesses closing? Or and this is an essential service, that people will be needing regardless of the pandemic. So what's your outlook on this? And also for first gen, there were at least offshore, a lot of the renewable energy companies actually still performed quite well. What's your long-term outlook on first gen?
Well, for first gen, I think even if we saw lower earnings, it's actually in line with consensus estimates. And we
Okay.
actually see for FGen is actually one of the least vulnerable in the power sector. I think just keep in mind that some companies are being affected by lower WESM prices. For FGen moving forward, keep in mind that around at least 90% of its natural gas is covered by long-term power supply contracts. So meaning, moving forward, if there will be significantly lower WESM prices because of lower demand, FGen will be the least affected. When we compare it for say Meralco, that all of its operations are in Luzon, and given the community-wide quarantine, it will affect specifically its clients in the industrial and commercial sector. So that's what we are seeing, and that's what we're looking at right now.
Okay, so it will be hit, but not as hard hit as others because we've actually invested long term. FGen down by 0.6%. Royce, I just want to check in with the markets with you. And last question here: do you tend to have a revision already on your year end calls to the index now that businesses are starting to open? We've actually digested some of the downgrades on your P, and some analysts are now setting calls, or at least are you seeing us ending at levels above what we are seeing right now?
Well, in terms of our year-end forecast, we're a bit more positive compared to the others. We're looking at around 8,000, but that's solely on fundamentals. When we look
Okay.
at the price action, it may or may not reach 8,000 year end. But keep in mind, what we tell our clients, if it doesn't reach 8,000 by year end, it means the market is cheap, and that it's more reason to accumulate. So that's the mindset we are setting in our clients as of the moment.
Okay, very interesting. So on a fundamental level, we should be hitting 8,000. If we haven't hit that, there's still room to be hitting that. Maybe not this year, but in the long term. Thank you so much for your insights. It's Royce Aguilar of First Metro Securities. And that's a first look into the business day. Today is Tuesday, May 19, 2020. Thank you so much for watching. Catch us again tomorrow, 10:30 a.m. I'm Danny Laurel, and we are One News.